Welcome to Three Crowns Trading. Please support our channel and click on the subscribe button, click on the like button, and today what we're doing, we're looking at some gold producers and gold in general again. So back on the 30th of September, we looked at 6 gold producing companies from around the world, and back then the gold price was at $17.52. The current gold price is $17.68. And since that date until now, that's around about 3 weeks ago, this is what's happened to the gold price. So Newmont Gold has gone from $53.90 to $57. It's up 5.5%. Barrick Gold is up nearly 5% in just over 16, 17 days this is actually. Newcrest is up 6%. Northern Star is up 9%. Anglo Gold is up 18%. And Regis Resources is up 14.62%. So if you had have invested when we recommended to do so 16 days ago, they would have been your current profit margins, which is pretty fantastic. And as we said back at the time of identifying these particular companies, the PE ratio of all of these companies is reasonable. Newmont's getting a little bit high, but it's still reasonable. Debt to equity ratios of those 6 companies is fine, and the dividend yield is fine. So here's a chart from the bottoming of the gold price until today. And as you can see, the price of gold bottomed around here. From the year here, it's down 7%. However, all of these companies are still down a great deal from the gold price. And what happened here, around the end of September, when we actually identified these companies and we recommended buying them, the prices have started to trend up. So Regis has gone up, as I said earlier, over 9%. Northern Star Resources is up. You've got Anglo Gold up from here, this line here, and all of the other companies and gold producers are following. So people are now realizing that there's still a lot of value left in gold mining stocks. And that's what you can see being reflected in the gold mining stocks share price. Okay, so here's the 5-year gold price, and this is what's happened. Since around August, the price has been trending up a great deal. We had a peak here, we had a nice channel down to here, and then we had this change in trend. And the change in trend has had a nice support line here, but it's also had a resistance line, and this has formed a diverging wedge. And as you probably know, with diverging wedges, as this divergence gets closer, the price should either break to the upside or to the downside. And here's a closer view of that. So this is the gold price for the year to date, and there's your diverging wedge. And what we found happened, the gold price, as expected, the gold price hit 1800, and that was the resistance line of this diverging wedge. So as expected, it came down, and a lot of traders, day traders, gold traders who were looking for that sold out. So you see the price come down, and the prices of those 6 gold mining stocks we showed you in the previous charts have also come down, because there are people who are not looking long term, they are just trading these stocks as well. So what to do now? If I was looking to get involved in these particular stocks, I would look to buy as this gold price hits the bottom around here, because this should pull down the price of those 6 gold mining stocks and gold mining stocks in general, and that would be your entry point if you're looking to get into gold. And then what we should see happen, the price will go up, it's going to come down, it's going to come up, and it should stay within this wedge. And then something's going to happen. It's either going to break to the upside or it's going to break to the downside. You could wait, if you're waiting to get into stocks, you could wait to see what does happen just to be sure, or you could take a chance and get in a bit earlier. If it breaks to the downside, then what's going to happen? The stocks and the gold price is going to start doing this. It's going to start going down, and then we're in a new trend again. And we're going to be in that trend until we see a change in trend. So that's one thing that could happen. The other thing that could happen, the price comes down, you ideally buy at this point, maybe, if you're interested in getting in gold stocks, and then the price goes up, it comes down, it comes up, and then it breaks the resistance line. And then what we would find is this bottom line is acting as support, and the gold price would then trend up in a fashion like this. So they're the 2 things that we're looking for to see what's going to actually happen in the gold price. And those things should happen within the next week or 2, because this divergence is getting closer and closer. What's supporting the price of gold? Inflation is a huge thing. And here are some items that have seen huge inflation over the last year. So car rentals in the States up 42%, 43%, gas 42%, steak 22%, lodging 20%, and bacon 19.3%. Obviously not everything went up. A lot of technology-based industries and technology-based items have actually gone down in value, but generally inflation is going up, and inflation is going up currently than people's wages. So it's a bit of a scary time. A lot of people were given lots of money by the government, so they kept spending and they kept spending, but now those government grants are running out, and now a lot of people would be dipping into their savings, and unemployment is still high. So we're seeing a lot of people would be struggling right now, and inflation is not going to stop, not anytime soon anyway, because we have these huge supply chain bottlenecks, and that supports inflation because people just can't get as many goods as they were used to, and that's going to push prices up even further. So if inflation does continue, we are expecting the gold price to go up in this sort of fashion, and we won't hold forever either. When the gold price reaches a level that we feel we're comfortable with, we will take profits. We take profits and then we look for the next commodity that's been beaten down to invest into. Gold price influences. So as I mentioned, the gold price is trading sideways. It's getting closer to the end of that diverging wedge. And here are the positives that are supporting the current gold price. The gold price is actually, the gold stocks actually are cheap historically, as I showed you in those previous charts, certainly compared to the gold price itself. There is a huge demand for gold right now compared to supply. We've got stagflation occurring right now. We're seeing inflation running rampant, but we're not seeing a lot of economic growth. The only growth that we did see in the last year is because of the government printing trillions and trillions of dollars around the world and pumping up the economy. But that can't go on forever because stocks have reached a height where they just can't, there's no fundamentals to push the stocks up higher. We've got inflation running rampant, and we've got rising bond yields. So people see bond yields rising as a negative for gold, but if they're rising due to inflation, that's actually a positive for gold. The negatives for gold, so if the interest rates rise, if the Fed puts up interest rates, then that's going to be a huge negative for stocks in general and gold. However, the chances of that occurring are very, very slim for a while, and possibly for a decade or more. It's really a tough time for the Fed right now. They don't really have a lot of room to move in terms of raising rates or even tapering as well. So we've got rising bond yields, which I just mentioned. They're at 1.6% right now for the 10-year. And as I said earlier, if the yields rise because the economy is strong, that is a negative for gold. But if they're rising due to inflation, that's actually a positive for gold. And they're rising due to inflation right now. A stronger US dollar is negative for gold. A correction, obviously, a huge drop in stocks and prices will bring down all stocks and all commodities. That would be negative for gold, and tapering is negative. So as I mentioned earlier, we're looking specifically at gold right now because we identify it as an area of weakness with a huge upside potential. However, if you look at other commodities, look at crude oil, for example, look at energy in general, most of these commodities have had such a huge run. I mean, 71%, 106, 400% nearly here. It wouldn't be a good time to get into the energy sector of the market right now. You should have got involved in this area 8, 9, 10 months ago and ridden it out. We would be looking to unload our positions right now in these areas. And as you can see, a lot of these actual energy areas, these energy sectors, are actually starting to come down in price because they've run up so much. So energy for us is not a sector to get into. It's possibly a sector to get out of actually right now. And here's the metals, some precious metals. So for us, gold, silver, it's down nearly 7% for the year. It still represents great value. Yes, it has had a bit of a run up in the last 2 years. However, it still has a long way to go, and it still has a possible nice future in the near term anyway. If we look at iron ore, that looks good in terms of percentages. However, it's run up so much, we still will not be interested in iron ore right now. Lithium obviously has got a great future. However, again, we'd be looking for a pullback here before we invested in any of these sort of sectors as well. And industrial commodities as well. Coal, obviously 10 years ago, people wouldn't want to touch coal. It was like oil was a year or two ago. However, now look, we're seeing a resurgence. We're seeing a resurgence in most energy sectors that provide base power electricity, because this push and this quick move to renewables was done without a lot of forethinking, and a lot of the energy that's being produced by renewables isn't enough to power societies. If the sun doesn't shine, if the wind doesn't blow, we have to return to these baseload power generating commodities. So stuff like coal and oil, gas are having a huge run like that right now. However, as we said, you should have got involved in these stocks months ago, so we wouldn't be looking to invest in these areas either. We will in the near future. As gold peaks out, and maybe in a year or 6 months, a year or so, we will look to exit that particular commodity and move into something else. However, right now, the only place we see real value, the only commodity that we see real value for what's occurring right now in terms of the economies of the world is gold. So we're looking to stay in gold and maybe exit in the near future when the time is right.